Most people believe that investing gets more complicated as you get older, more products, more strategies, more decisions. That belief is wrong. In reality, after 65, the smartest portfolios usually become simpler, not more complex. And for most people at that stage of life, complexity is not a sign of intelligence. It is a source of risk. If you are over 65, your primary financial problem is no longer how to maximize returns. It is how to reliably convert the wealth you have already built into stable purchasing power for the rest of your life. That shift changes everything. The incentives change, the time horizon changes, the consequences of mistakes change. At this stage, volatility is no longer an abstract concept on a chart. A large drawdown is not just uncomfortable, it can permanently reduce your standard of living. Unlike a 30-year-old, you may not have the time, income, or emotional capacity to simply wait it out. This is the part most people ignore. The financial industry does not like simple answers. Simple answers are hard to monetize. But reality does not care about product shelves or marketing narratives. Reality only cares about cash flow, inflation, and behavior under stress. When you strip everything down, investing after 65 has two core requirements. First, your portfolio must grow enough to protect you from inflation. Second, it must be stable enough that you are not forced to sell assets at the worst possible time. Everything else is secondary. This is why, for most people over 65, only 2 Vanguard funds are actually doing the heavy lifting. Not 10, not 15, 2. The first is a broad U.S. stock market fund, a fund that owns the entire productive engine of the American economy. Not individual stocks, not sectors, not themes, just the market itself. The reason this matters is simple. Inflation is not a theory, it is a certainty. Over long periods of time, cash loses value. Bonds struggle to keep up. Businesses collectively do not. Companies raise prices, they adapt, they pass costs through. Owning the market means owning that adaptive capacity. Many people over 65 are told they should avoid stocks almost entirely. This advice sounds safe, but it misunderstands risk. The real risk is not short-term volatility. The real risk is living 20 or 30 more years while your purchasing power quietly erodes. A broad stock market fund is not about excitement. It is about accepting that you still need growth, even late in life. Just not reckless growth. The second fund is a high-quality bond fund focused on U.S. government and investment-grade bonds. This fund serves a very different purpose. It is not there to make you rich. It is there to give you stability, liquidity, and psychological control. Bonds reduce volatility. They provide income. They act as a buffer when markets fall. Most importantly, they give you something to draw from when stocks are down, so you are not forced to sell equities at depressed prices. This is the behavioral side of investing, and it is far more important than most people admit. A portfolio only works if you can stick with it. Bonds make that possible. What most people misunderstand is that diversification is not about owning many funds. It is about owning assets that behave differently under stress. A total stock market fund and a high-quality bond fund already do that job remarkably well. Adding more funds often creates the illusion of control without adding real protection. International funds, sector funds, dividend funds, alternative strategies. Each one introduces new risks, new correlations, and new decisions. Decisions that you may not want to make at 75% during a market panic. Simplicity is not laziness. It is risk management. Another misunderstanding is income. Many retirees chase yield. They focus on dividends, distributions, and payouts, believing that income equals safety. This is a dangerous idea. Income is not safety. Stability is safety. A portfolio that grows steadily and can be drawn from flexibly is far more reliable than one designed to maximize visible cash flow. Dividends can be cut. High yields often signal higher risk. Selling a small portion of a stable portfolio is not failure. It is how capital is meant to be used. The two-fund approach forces discipline. It limits overreaction. It reduces the temptation to tinker. It aligns with how people actually behave, not how they imagine they will behave in theory. Asset allocation between these two funds matters more than anything else. The exact percentage depends on health, spending needs, and risk tolerance. But the structure remains the same. Growth plus stability. Adaptation plus protection. This is not exciting advice. It will not outperform headlines. It will not give you something new to talk about at dinner. That is precisely why it works. After 65, the goal is not to win the market. The goal is to remove unnecessary ways to lose. Most financial mistakes at this stage are not caused by bad markets. They are caused by bad decisions under pressure. Too much complexity increases the chance of those decisions. The uncomfortable truth is that investing success later in life has less to do with intelligence and more to do with restraint, the ability to accept average returns in exchange for predictable outcomes, the ability to ignore noise, the ability to say no to products designed to feel sophisticated. Two funds force you to confront reality. You cannot hide behind strategy. You cannot blame performance on the wrong allocation or the wrong manager. What you see is what you own, and that clarity is powerful. If you are over 65, your portfolio should not reflect ambition. It should reflect understanding of time, incentives, and human behavior, because at this stage, the smartest move is not doing more, it is needing less. And that is where real financial security actually comes from.